Welcome back, everyone, to another episode of Real Estate 360 Live. For those of you not familiar with the podcast, my guest and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington. Anything that affects your real estate decisions will be covered here. And unlike many other real estate podcasts and shows, radio shows that are done throughout the country where you pretty much talk about, why it's always a good time to buy, we won't do that here. We'll kind of dissect what's going on in the economy, what's taking place at the congressional level, what's taking place at the Federal Reserve, and the decisions, the interest rate decisions, and quantitative easing decisions that they make, and how that can affect you. Probably many people may feel, I've got a lot of listeners that actually have written in over the last couple of months saying that I'm somewhat pessimistic on the overall housing market. And the reality is I don't want to be pessimistic because I'm in this business each and every day, but I do want to let people know that, part of my job, not just as a real estate agent and an investor, I need to be future pacing where things are going. And it's very important and critical that we pay attention to what's taking place economically, and especially when it's being artificially manipulated for an extended period of time. You want to try to stay ahead of the curve. And that's what we're here to do, is to give you the information to help you make educated decisions. Now, if you don't agree with what we talk about, that's fine too. We haven't always been right. We many times predicted that at some point that, the party of the quantitative easing should have stopped a long time ago. It finally is looking like it's coming to a halt. And today we're going to kind of jump in and talk a little bit more about the Fed and their meeting this past week. We're also going to talk about Russia and what the craziness that's taking place over there. We'll dive into the potential or the real estate myth that's out there, that there is still a housing inventory shortage. And we'll take some of your questions that you've written in over the last couple of weeks. Remember, if you haven't already done so, to go to iTunes, where you can download and subscribe to our podcast. It's Real Estate 360. So if you search for that in the search bar on iTunes, you can download the podcast or you can subscribe. It would be greatly appreciated. If you'd like to leave some reviews, feel free to do that. We'd love to have your feedback. Joining me on our panel, as he does each and every week, is Louis Camerosano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. Louis is often cited in the media as a real estate industry expert. He's been cited in Boston Globe, Inman News, Wall Street Journal, Forbes, Smart Money, MSN, and numerous others. Louis, how you doing today?
I'm doing splendid, Ryan. How are you?
I'm doing well, sir. Thanks for asking.
Excellent.
So, obviously, we've had quite a bit transpire since last week. I think where I would like to start, we'll jump into the Fed in a little bit, but one of the most pressing issues that we have taking place right now globally is Russia. And I wanted to get your take because yesterday I was paying attention to mortgage rates, and obviously with the global unrest and uncertainty, typically money flows back into the safe haven of bonds and mortgage-backed securities. So pricing, interest rates got better yesterday, and what is taking place in Russia right now is pretty scary. I mean, they're saying that there's these geographic regions in the Ukraine that are now being organized by pro-Russians to seek out independence from Ukraine. So they're going to actually hold elections, and I believe in I can't remember, 55 different territories over there, and basically ask them one simple question: do they support the active proclamation of independence? And if they do, potentially, it's going to open the doors for Russia to basically come in and say, look, they're declaring independence, and they can rationalize to the rest of the world that they can move in and support these independent democracies. So essentially, Russia's going to come in and take over. Obviously, it looked like at some point there was going to be they were going to work things out over there, but now the tide has turned and everything is heading back to the direction that it started. What's your take on this? Obviously, in the real estate market and for the bonds and everything else, this is helping interest rates once again, where typically when you have the Fed tapering off again, mortgage interest rates should start to go a little bit higher, but it's already kind of baked in that was going to take place. But with all this global uncertainty in Russia, this seems to be the featured film, so to speak, right now, of what everybody's paying attention to. And, mortgage interest rates are benefiting from this. What's your take on Russia, and where do you see it going from there?
Ryan, the media has done a great job of downplaying the significance of the events in Russia and, of course, upplaying the economic recovery and the housing recovery. There's an astonishing level of persistent denial of economic reality. So on Russia, and remember, what happens in Russia and all these geopolitical events and even quantitative easing, the results are not immediately apparent. There's a knee-jerk reaction to the events, but the long-term consequences do not get priced in immediately. And the long-term consequences are the United States appears to be powerless to stop Russia from moving into the Ukraine, because the only way to really do that is to use military force, and that could escalate. I don't think anybody wants to get in a situation where the United States uses military force, over Ukraine and starts World War III with potential nuclear weapons being launched. So Russia knows that all it has to do is appear that it's playing by the rules and is going in there, asking the people what they want. It's a democracy. They vote for Russia, and then they take Russia they take the Ukraine without having any real, having to fire any shots. We know that Europe is not keen either on trying to push back Russia, because Russia is their gas station. That's where they get their natural gas and oil from. They don't want to really annoy Russia. And frankly, the United States and NATO already have a perimeter of NATO countries that they've expanded over the past 10, 15 years. It's not just Western Europe. It's moved into Eastern European countries too. So there's not really an issue of security. However, the United States is not going to just sit back and say, okay, go ahead and take Russia. They're going to do the foolish thing, which they are doing, which is impose sanctions. And that's what's going to have the long-term consequences, Ryan, on the United States, because the United States, as we've discussed many times, is reliant upon having the world's reserve currency and there being a demand for dollars, which allows the United States to print dollars in excess of our tax receipts so that we can continue to support our welfare and warfare state. Without the U.S. dollar as a world's reserve currency, we couldn't fight the wars, we couldn't support Obamacare, we couldn't support all the welfare we do at home, the food stamps, even whatever government programs we have, they are in part funded by excess spending that's only available because we have the world reserve currency. And if we put sanctions on Russia, Russia will just accept the sanctions, but then start to move away from the United States dollar in its international transactions and start to trade more with countries in the East and start to use currencies other than the U.S. dollar. When Russia and other countries like China use currencies other than the dollar, eventually that will have an impact on the value of the dollar, and that will end up sending interest rates higher and causing inflation at home. Now, this is all speculative if these things happen, but it appears that Russia's reaction to the United States putting sanctions on it will be not just to dump their treasuries and to stop buying them, but then to stop using and creating demand for dollars. Same with China. China has spoken out in the last year about removing their funds for U.S. Treasury. Their appetite has been reduced to basically nothing. And they and Russia are building their gold reserves so that perhaps they can back their currencies, buy gold, the ruble and the yuan, and trade with other countries other than the United States and perhaps even Europe in currencies other than the dollar. So that's where we have to look as real estate observers, is what will happen to interest rates if that happens. That's a situation that the Fed doesn't control. The Fed can't just come in and say, well, we're just going to keep rates low. There'll be no demand for the U.S. dollar or reserves if people aren't using it as much. So what has to happen? The Fed has to buy more U.S. Treasuries to try to keep interest rates low. They can't just set rates. Or the United States has to stop spending, which is not going to happen because that's on automatic pilot, and the spending increases every year. So short term, it's good. It looks like there's a crisis, so money flows into the United States. running towards the blast, as it were, and interest rates go low. But long-term or mid-term, this has the potential to spiral out of control where the U.S., if it loses its status as a world reserve currency, everything changes, and the Fed no longer can be in control.
Yeah, I agree. I agree with that, and it brings me to my next point. Obviously, we had the Fed meeting again this week, and they continued the Fed speak of we're going to continue to taper. They cut their purchases back now to $45 billion a month instead of $55 billion. So it moved on the mortgage-backed mortgage bonds that they were buying from $20 billion from $25 billion, and Treasuries from $30 billion to $25 for a total of $45 monthly. Do you think it's any coincidence that we do have all this stuff going on globally right now, Louis, that they're not factoring some of the stuff that you're saying as far as, the dollar and the weakness of the dollar in Russia and China and all this? I feel like if they didn't continue tapering on, that would even show more of a weakness in the United States, right? And it's almost like if we continue down this path of cutting out QE, it's telling the rest of the world, look, we're weaning off of QE. We don't need it anymore. Things are turning the corner. But yet, if we stopped, if we held where we're at, or we reverse course, then everybody would see the United States is in trouble because the statements that are taking place, that Yellen's saying that the economic indicators are still not strong enough to defend higher rates, meaning the federal fund rate. They don't want to touch that, but they're willing to continue to pull that quantitative easing off the table. Now, if the economic indicators aren't strong enough to change the federal fund rate, why are the economic indicators strong enough to pull a QE?
Right. Classic rhetorical question. It doesn't make any sense.
It doesn't make any sense at all, right? And I think that most of what you just spoke about in regards to Russia and the potential of the U.S. losing the reserve currency, I think that all of this is factored into the Fed's decision. It almost has to be. Because
they're supporting the dollar. You're right. By tapering, it shows that they're not just mad money printers and that they're prudent stewards of the dollar. And also, they have to say the reason they're tapering is not just to protect the dollars, because the economy is improving.
Absolutely. And so for other countries that would potentially buy our treasuries, they might not be scared away, right?
Correct. They've already blown it because Russia and China have already stopped buying them. They've seen enough over the last 5 years. They didn't like QE when it started, and it continued too much to the point where they finally threw in the towel and they said, we don't need this many U.S. reserves. We can buy other things with the excess money that we're making from our production in China and our oil and gas sales in Russia. We're going to buy other stuff. A lot of it's been gold. They've been buying mining companies. They've been diversifying their reserves, especially if they're considering on not having to use them to buy goods and services internationally. If they can use some other currency or accept some other currency, reduces their need for U.S. dollars.
Yeah. Yep. And so I think that, this is more of a play for the Federal Reserve in trying to get the rest of the world to still buy into it outside
like Japan and Europe.
Correct. Yeah, and I could see, Europe actually being the next big buyer of our stuff because they already basically said that they're going to turn on QE as well, right? Wouldn't be surprised if they come in and start swooping up our MBS and treasuries. It's a possibility.
Or are told to do so as part of, just like the petrodollar was created whereby we agreed to defend Saudi Arabia as long as they agreed to accept and price their oil only in dollars. We could do the same to Europe. We could say NATO is now contingent upon you ponying up money and buying our treasuries.
Right.
And kind of creating a euro dollar.
And, we always talk about, these backroom deals that are taking place. We know they have to be taking place. I mean, our markets are so manipulated, it's not even funny at this point. I mean,
they're 100% manipulated.
Yeah, and it's everybody is always like, well, I don't understand. The technical indicators yesterday said mortgage rates should do X, Y, Z. And I've told people for a long time, I said, look, I pay attention to technical indicators too, because, when you have levels of support, you have these ceilings in place that, you need really bad news for them to break through those ceilings. And when we have the artificial manipulation that's taking place, is actually, the reverse is happening from what we would normally see. And that's just because of the intervention that's taking place here, the meddling in QE and interest rates. If we had a natural free market, you would be able to say, okay, this report came out today, this is where interest rates are going. But no longer are we able to do that. We're always going to say, okay, we're going to interpret the report, and then we're going to interpret how the Fed's going to interpret the report, right? So then the Fed's going to interpret the report and give that piece of news to the media, and then the media is then going to take and spin it and interpret it how they want to interpret it, which is always positive. It's never negative. So,
case in point, Ryan, GDP release last week up just 0.1%. Okay, so what they say is, oh, it's the weather, things are going to get better. You know, cold weather should not derail an economy to the point where it's at 0.1%. You know, the recent tornadoes, the tragic tornadoes that destroyed many homes, that might be an excuse for the second quarter because that actually does put economic activity to a standstill when swaths of homes are leveled. Now, of course, Keynesians will say it'll stimulate economic activity because they can now rebuild them. But the level of spin really is astonishing. So after the FOMC meeting, the Federal Reserve meeting in March, CNBC says, yet the Fed's statement did not reflect substantive concerns and, in fact, agreed with consensus from economists who believe the slowdown will be short-lived and growth will accelerate. Why? Who are these economists that are seeing that somehow there's fundamental basis to think that the economy is just going to accelerate because it fits the narrative? That's the only reason I can think. And the Fed minutes say growth in economic activity has picked up recently after having slowed sharply. Well, where? Right. If you look at home ownership rate is down. Jobless claims are up. Well, there's excuses there. There was the weather, and of course, there was Easter, too. Well, don't the economists know Easter was coming when they made their forecasts? It makes no sense. And then you have 20% of American families have everyone in it unemployed. You've got a rise in food stamps, mortgage applications are down, home sales are down, new home sales are down, and yet they persist in saying that everything is just fine. And then another quote, Ryan, I just want to – here's what Reuters says. U.S. consumer spending, which did increase in March to the largest amount in 4.5 years. Now – a lot of that is just spending on extra money you have to spend on health care. But it says, cementing the view that the economy ended a dismal first quarter on solid footing. So they've got one aberration where somehow people managed to dig in their pockets and spend money in March. But even that wonderful March of spending still did not produce barely a positive GDP. But they will persist in telling you that the economy is fine. It fits in because they can't say the economy isn't doing well because then they'd say, well, get to the QE. You got to do more QE. Right now, it's most important that the Fed has this credibility, that they're staunch, prudent defenders of the dollar, the economy is doing better, and therefore they can taper. And if there's problems abroad, well, now I feel free to come and buy U.S. Treasuries because the dollar's getting stronger. In fact, though, Ryan, if you've checked out the dollar in the last month or two, it's dipped below 80 on the U.S. dollar index. And it's kind of persistently stayed there. But what you haven't seen at the same time is a rise in gold and silver, which normally goes in a converse relationship to the U.S. dollar.
Correct.
And, of course, we've seen some of these smash crashes of gold and silver in the past year or so, where someone will sell in the middle of the night large positions of gold and silver without any regard to getting a good price. They'll just dump a whole amount. And the only reason anyone would do that, Ryan, no one in their right mind, if they had a large position, would sell it all in 13 seconds. They would try to get the best price. They wouldn't signal. And the only reason to do that, many suggest, is to lower the price of gold and silver.
Yep. Yeah,
so this goes into your point. Everything is manipulated. And they're trying to get a result and a narrative. The economy is improving. The dollar's doing well. Everything's doing well. And yet the housing numbers don't show it. The employment numbers don't show it.
Our
but
GDP
the stock market still does. What's that?
The GDP doesn't show it. I mean,
no.
And if 0.1% was the number, I bet you the real number was negative, Lewis. They somehow
Brian, they include healthcare costs, which are up 4.4%. Now, healthcare costs shouldn't be included in the GDP. That's a detraction. That's an expense.
I mean,
if they just get us more sick and we spend more on healthcare, and then if it gets colder, we spent more on energy, and they include that in the GDP. These numbers are ridiculous. They'd be negative.
I mean, it would be negative. And imagine trying to spend a negative number, right? It would then be the weather again, right? I mean, they have to. They're just
that .1. You're absolutely right, Ryan. If it had been, they would never have released negative .1.
No, it has
because
to be
2/4 of negative is officially a recession.
Correct. And then and people are like, well, they can't manipulate these economic reports. I was like, of course they can. And these surveys and everything else, who chooses the subset of people that are surveyed, right? They say it's at random. Do you not think that they're probably, surveying the top 20% of people? They're not gonna, choose to survey the bottom people because their numbers would be outrageous. And they can say it's random and all these things. That's why I tell you all the time, Louis, but I could care less about the actual reports. We talk about them because this is what the markets use to interpret how the economy is doing, and we need to talk about
No, they use it to interpret how the Fed will interpret how the economy is doing.
Correct.
All news is good news in this economy. Doesn't matter.
Yeah, it is.
It's bad news, it's temporary, and the Fed will do something about it. If it's good news, occasionally, that's good news too.
And at any
Nothing
point,
drives the market lower.
No, and at any point the Fed can step in and say, you know what, I'm just not going to pay attention to that number anymore. As in case in point, the unemployment rate supposedly is down from 10% to 6.7%. However, Yelp and company now, they don't feel that they want to pay attention to the unemployment rate anymore. Now
because it doesn't accurately reflect the true state of the employment market. Well, it never did.
And why doesn't it? Because the labor participation rate's terrible, right? The labor participation rate
gone
is
down.
It's
like the home ownership rate has gone down. That's not a recovery.
And I actually saw a report where it was almost like 70% of the new jobs, and I can't quote the source because I can't remember where I saw this, but almost 70% of the new jobs, the new hires that are taking place right now, are temporary part-time positions.
Right.
They're not even full-time positions. So, these are not what I would call real jobs, right? They're temporary. These are for people that are going to take that one job. They might have to work 2 or 3 of those jobs just to make ends meet. And they may be lucky not even to be able to do that. But
that's why first-time home ownership purchases are at an all-time low.
Yeah, because people that have multiple part-time jobs are not buying houses. They're not.
Recent graduates who have no job or a part-time job and student debt, and they're not buying houses. That was another myth, wasn't it? Household formation represents pent-up demand. No, it represents pent-up desire. It doesn't represent pent-up real demand. Because you pointed out a couple of weeks ago, willing is one thing, able is another.
That's the biggest component in buying a house. And like I think you said a couple of weeks ago something to the effect that we could all want to be millionaires, right? But it doesn't mean we're going to be one. And it's no difference in buying a house. I mean, everybody probably desires to own a home. I mean, it is a good thing. And guys, remember, at the top of the show, I said, this is, a lot of this is negative stuff that we're putting out there. But remember, the interest rate environment that we have right now is fantastic. So there's people out there, let's just call them the 20% of people that can take advantage of this. That if they're lucky enough to take advantage of this, then I'm all for it. I'm all for somebody taking out as many loans as possible right now with the low interest rate environment.
And there are people doing it.
And there's people doing it right now. Now, should some of those people and investors be cautious of what's taking place right now? Absolutely. But they're not going to stop riding this train until it hits their pocket, right? So when is that going to take place? I couldn't tell you, but I will tell you that we're going down a slippery slope for sure. It's so funny because, like I said, the Fed can take its eyes off of whatever indicators they want. They can change things up. They can change their narrative at any point in time. And as they've moved away from looking at the unemployment rate, they'll start looking at something different. Now, all of a sudden, they're taking into account a wide range of information that includes the measures of labor market conditions, indicators of inflation pressures, and inflation expectations, and readings on financial development. Now, that's just some broad thing that they're throwing out there. Basically, they're just going to say that they're going to keep their eyes peeled, and if they feel the need to change anything, they will. Now, with all the global uncertainty that's taking place right now, they're not. I guarantee you, they're going to continue to taper. They're going to, and this is going to take us basically, Louis, when I had mentioned a couple weeks ago about we're heading into the next election. Do you really think that they're going to want to reverse course when we're going to go into another election? Nope. Probably not, right? They have to continue this story. So that's why I said we're at least going to get through the end of Obama's term with nothing really changing. We cannot damage his credibility and the so-called legacy that he's trying to leave here. So
he's trying to say what, Ryan? That we had the worst financial crisis presented to us by Bush and the Republicans, and through decisive action through the Fed, which oddly enough Bernanke was appointed by Bush, we have sailed through this, and we are doing fine. And, we would have done even better if the Republicans had let us spend more, and we would have done better if we had just entered the economy in a normal state. That's exactly how they want to portray it. And if you look about what you learn in the history books today, we hear incessantly that Theodore Roosevelt led us through the Great Depression, and it was all Herbert Hoover's fault, which is absolutely false. Herbert Hoover was using government programs to no avail. Roosevelt campaigned against using government programs. First thing he does when he comes in, he uses the government to a level never seen before. He confiscates the citizens' gold. He calls a bank holiday, and he institutes a slew of new federal programs and spending, which did nothing to get us out of the Great Depression. We had spent 10 years into the Great Depression. We had a depression during the war, continuing. It wasn't until after the war that finally things started to pick up. But yet, that's the legacy, and I think that's the legacy that Obama is angling for, is that he got handed this pile of poo, and look what he did with it. He kept the country through it in spite of the fact that he was the first African-American president facing, all of these slings and arrows, and yet he still led the country through it. That's what he wants to do. And that's what the media wants the narrative to be.
Absolutely. And you can see it going down that path. And you can see with the Federal Reserve and what they're doing, heading into, if they stop at any point, if they say, we're going to pause on the QE, then guess what? Everybody is going to interpret that as, we're in trouble.
Right. The economy is not getting better. They're tapering into recession, and it's just like taper on, and they don't care what the headwinds are, what it looks like. They are going to go ahead and get this credibility taper done and finish QE.
Yeah, because you know what, Louis? Just imagine. I mean, if they continued to taper, these numbers are going to continue to get worse.
Of course,
right?
They're already showing up in the first quarter. The second quarter is not going to get better. They have that tornado to blame now for the second quarter.
And when you keep those, keep the purchases of more and more MBSs and Treasuries, and still, the employment situation gets worse and worse. It just highlights even more where they thought that they could do something. They thought that they could do something, but they really couldn't. And it's just
embarrassing. $4 trillion of loan, and this is where we are 5 years later at 0.1% GDP growth. If you were a corporation, you'd get fired. If you entered a 5-year plan and you were going to spend shareholder money and you were going to raise billions of dollars by issuing debt, and then what you were going to do is take that money and put it into the company, and 5 years later you're going to be mega profitable, and you're not. You're barely making $3 a year, and you spend billions of dollars, you'd be finished. You'd have zero credibility if you went on that kind of spending spree. And got no results.
If we relate this back to basic business, but just like you're doing right now. I don't know if you watched the show The Profit, Louis. It's on CNBC. It's actually a really good show. And the reason why I like the show is because they go into all these companies, right? It's basically an entrepreneur that's out there, basically a venture capitalist that has all this money. He just likes to go into businesses and take over, essentially, right? Get 51% control and completely take over. Well, almost every single show, whether it's a smaller business, a medium-sized business, they come in and they've got $4 million in revenues, right? When they get to the bottom line, they're negative $100,000. This highlights the fact of what we were talking about with the stock market and companies like Twitter and all these other ones, which is it takes that small business number and it blows it to epic proportions, right?
Right.
So he's like, that's great that you have $4 million in revenue. You didn't make any money, right? So
well, they should go public, and then they would, because the shareholders would buy up their stock as long as the revenue grew from $4 million to $5 million the next year. Even if they lost more money, they'd have a few $100 million market cap.
But the interesting part, Louis, is when I started thinking about this. So this is obviously on a show, and they're going to obviously pick companies that he's going to invest in. For the most part, he almost invests in every one of them. But this is a real problem, though, because this is not just on TV. This is everyday businesses that this is taking place, right? There's not many small businesses that are out there that are thriving. They could be doing a couple 100,000, a couple million, tens of millions, and still not making any money.
Right.
This and the overall economy and the numbers we're looking at would kind of show us this. These small businesses are not able to go out there and hire more people. And you know what? That's great, Yellen, that you want to hold the interest rate, short-term money, the federal fund rate at next to nothing for an extended period of time. Who is that helping? It's helping the big banks. It's helping the hedge funds. It's helping the rich. But at the same time, you're reducing, the QE, which is really not doing anything anyway. If it was doing anything for a short period of time in the very beginning, it drug interest rates way down. It's lost its effect at this point. But the person that's getting crushed every day is the middle class. They're getting pushed down further and further down the ladder. The rich are getting even more rich, and will continue that path. And at some point, Louis, you had an article, another blog post on your smallgold.com site about the housing inventory shortage myth, where, you went into great depth just basically about, how everybody wants to talk that it's, it's a lack of inventory. And we've touched on this before, but there's actually, when you go out there and you have a graph on your site, so if you guys check out smallgold.com, SMAULGLD.com, there's actually a chart of the month of supply of homes in the United States. And you will see that from March of 2013 to March of 2014, we went from a 4.2-month supply to about a 6-month supply in about a year. Now, why would I can honestly see that, and Louis, you and I talked about this, that we were getting ready to go into this prime spring market where many major metropolitan areas, including where I live here in the D.C. metro area, that equity positions have changed, right? So everybody now all of a sudden, for the people that are not underwater, everybody has the same thought this spring. And it starts in March that, hey, you know what, I'm going to get my house on the market, I'm going to get this thing sold. So now we have...
And they want to get it sold at the price that they think the market is at, the inflated price. And the buyers look at that and they throw up on it. They say, no.
So there was a mad rush for everybody to get the house on the market, and that's what we're seeing. That's what we're seeing now.
And we predicted that last year in the blog post on Small Gold, real estate's underwater, downside, sticky catch-22, which said exactly what would happen. These higher prices would attract more sellers, which would, of course, add more inventory, which would, of course, have the effect of driving the price back down.
Right.
The demand isn't there.
Yeah, exactly. So now that we have the 6-month supply, we should expect then, Louis, since there's all of this pent-up demand, that when
it would lap up the supply.
Right.
The new inventory.
July, right. And when we get to July, that these numbers should go back down to 5.5 or 5, right? No, they won't. They're probably going to continue higher. And, what's going to happen is if we go 2 or 3 months with the supply going higher, we have real issues, because at that point, when there's a lot more inventory out on the market, what's the person that really wants to sell going to do? Lower their price.
Lower their price.
Right?
So Ryan, in the blog post, the housing inventory shortage myth, we also show another chart that shows existing home sales have declined in the light of the new inventory.
Correct. Now, and these are national
That
numbers.
wasn't supposed to happen.
Right, and these are national numbers,
What was supposed to happen
right?
was the inventory was supposed to increase,
yep.
and, the people would buy it, and sales would go up, and home prices would continue to rise. The reverse has happened. More inventories hit the market, sales have gone down. Prices haven't gone down yet, but the fact that sales are going down means they will.
Yeah.
Because the reason the sales are down is the buyers don't like the price.
Right. Now, one of the things that I get certain listeners, and we do have a lot of other real estate agents that pay attention to this podcast, they'll say, well, these are national numbers, and we know that real estate is local. Yes, I will agree with you. And it's hyper-local because, especially in D.C. Metro, San Francisco, New York, these different areas, they're going crazy. Now, so what will happen is, what we're seeing is the inventory, when it's going up in these other areas that are not big metropolitan areas, they're the ones that are first hurt. And it's going to be a delay. There's going to be a delay before it hits these metropolitan areas. But when it does, it's going to hit hard, right? It's going to hit really, really hard. Now, what's that delay? Is it 6 months to a year? Probably. It's probably somewhere in that range. It could be even a year and a half. My big question to you, Louis, and I thought about this. So what will the Fed do if they have to acknowledge at some point that the home prices are starting to fall? Because I would assume that consumer sentiment, consumer confidence, and the way people invest, that if all of a sudden home prices start to fall, we know what's going to happen to the stock market, right? If home prices start to fall most of the time, other than outside the institutional buying, any buying or confidence that people did have in the stock market would start to wane at that point. So what does the Federal Reserve do once reports start to come out that home prices are dipping down? Now, I'm not saying this is going to happen this year, but it's already happening in certain areas. Do you think they pull back out another card, or are they going to be, at that point, we're going to be kind of stuck and it's going to be tough to reverse course?
Well, the first thing they'll do is say it's temporary, and they'll blame the weather.
It was too hot. It was the Sahara Desert in the United States this summer.
And it was too cold. There was a tornado. Something happened. It was unexpected. The housing recovery remains on track, blah, blah, blah. They won't. They're not going to give up the concept of the housing recovery.
Well, and you know what? We talked earlier. It could be Russia, right? We could focus on Russia for the next 6 to 12 months.
Oh, easily. There's no. They think 6, 12, 24 months out, and they adjust accordingly. And we can't even foresee how they're going to spin, manipulate, what they might do. They've managed to convince the average consumer that there's been a housing recovery for a year, and you're only starting to see now, it's slowed down a bit. It never was there.
Right.
The only thing that's happened is there's been a few investors, I'm speaking generally, a few investors chasing a limited supply of homes on the market because there were no homes on the market because most people were underwater, and it drove the prices higher, and they call that a recovery. But as we've mentioned many times, every other indicator of the housing market is down. New home construction, existing home sales, pending home sales, mortgage applications. Many of these are at all-time lows. You can't have a recovery when some of your major indicators in the housing market are at all-time lows.
Right.
New home construction is near an all-time low, and in fact, on a population-adjusted basis, it clearly is. They're building about the same number of homes in the last 5 years as they built in the 60s and 70s, when the population was 35% lower.
Well, what's interesting, Lewis, is typically when the economy is stable or when it's starting to boom, lending picks up to epic proportions, right? Like the lending, we would expect for lending to be, small business to be thriving right now. But yet we have a low interest rate environment, and the amount of money out there to actually be lent out to small business or to even be had is like next to none. I mean, we've got lenders saying that their loan production is down 55% from year over year at these interest rate levels. It doesn't make any sense, guys. It doesn't make any sense at all. I mean, we've got a lack of inventory. We've got a low interest rate environment. All of these different things. If what was true of what the Fed sees that things are becoming stabilized, then you know what? We would see home sales pick up to really high levels. We're not seeing that. We're seeing the reverse happen, which it just tells you it wouldn't matter if interest rates went from 4% to 2% low. There would be a temporary spike, but overall, the lending underwriting guidelines would increase. Like they become more hurdles to get that loan because nobody wants to lend at lower levels. They don't. Right. So it's irrelevant as to what interest rates are. And I can argue, you and I can argue, Lewis, that it's actually better for interest rates to rise because the banks would be more apt to take risk and to give those loans out. But that's not what's taking place. So, and I mentioned the other day, so one of the loans that's out there that everybody is trying to get approved for is an FHA loan, because unless you're a veteran, which is like 100% financing, the next, almost best, there's a couple other programs out there, but FHA offers like the lowest credit scores. Some cases you can go down to 580 now. It's one of the things I've seen them start to ease back up on is their credit requirements were 640, then 620. Now they're moving to 580. Why do they do that? Because they're not getting any loan production, because people's credit is not that good. So they have to start to open up the floodgates of letting unqualified people back through the door, right? So
now you're dealing with the same dynamic you had in the mid-2000s where you have unqualified buyers. They pay too much for the home, and they can't afford it. And you have a new wave of foreclosures when you haven't funneled out the last round of foreclosures.
Correct. And the funny thing is they instituted all this regulation. The mortgage business is probably one of the worst businesses ever to be in right now, honestly, just because of the compliance and everything that's there. But they put all this, qualified mortgages, non-QM mortgages, And now we've got, the regulator that was the head of the CFPB left there is now starting a division for non-QM mortgages. Because guess what, guys? Nobody's going to do any loans. And they just find a way around the regulation. They create them. They charge higher interest rates, and things will move there. But it takes time for that to happen. And, typically 6 to 12 months before something like that will get put into play. But right now, there's, I would imagine it's probably, the number's got to be somewhere like 1 in 4 applications are going through. I mean, and I've made that number up, but that's what it feels like just being on the ground.
Right.
And the people that are eligible to buy homes right now have actually, most of them, been saving up money for a long time. They've had pretty stable jobs, and with the increase in the equity position that they have right now, they can potentially get out. Now, it's not everybody, but there's a bunch of move-up buyers that are doing that, but there's still, as you mentioned in your blog post, probably 25 to 40% of people that are still underwater. That is a big problem. And
big problem.
And with the increase in supply that's coming, is not good news for those people that are still underwater, because at some point prices will reverse course. And like I said, many agents across the country will say, well, my market's different. That can't happen here. It's only a matter of time. We haven't learned our lesson. We're repeating the same thing over and over and over again.
Encouraged to repeat it.
Encouraged to repeat it. It's almost in like 5-year cycles. Typically, these cycles, they're much further apart, but we're seeing them much closer together, and it's only because we have artificially manipulated markets. We would see more, more level. Wouldn't you just prefer, Lewis, just to see stable, like where it's really not going up or down, it's just staying the same?
Well,
you know what I mean?
Yeah, I would. If economic activity was slow, I would expect it to perhaps decrease at a rapid rate. And if economic activity was rapid, then I would expect it to go higher. If economic activity is tepid, then it stays in a. That's the way the real estate market used to react. But in the last 30 years, the stock market and real estate markets have been so manipulated by the Fed, with the beginning of Greenspan with his, the put after the 87 crash, and then the interference with long-term capital management, and then they're trying to jawbone down the NASDAQ, and then after the NASDAQ crash, trying to create a housing bubble, and then QE. The entire history of the last 30 years is based on no one in our club loses money. Those assets we're going to boost all the time, because that acts as a substitute for the country for a lack of production. It looks like we're rich. Our stock prices go higher, our homes go higher. We haven't done anything to earn those higher prices other than we have the world's reserve currency, and the Fed boosts asset prices. But if you think about home prices increasing, it's not a sign of wealth. The house is the same house as it was when it was built in 1890 or 1960 or 1990. Whenever it was built, the house increasing in value doesn't really make it worth more. They're just pushing the prices higher, so it is more. Same with stocks. Some of these companies, if you don't make any money and your stock price increases every year for the last 3 years, which many of these companies have, and they lose increasing amounts of money, the company isn't really worth more. It's just boosted higher. The underlying value isn't any more than it was 3 years ago. In fact, it's worse if it loses more money.
The value of most of these internet companies is in their list of people and the information they have on what they're buying, when they're buying it, right?
Wonderful.
I mean, Amazon, when you looked at Jeff Bezos, the CEO of Amazon, and he basically talks about how he was perfectly okay with running in the red for however many years it took, because he was going to outlast and put all these other companies out of business until he was the only one standing, which is essentially what he's done. And
the other ones can't do that, though.
Correct.
But they still have the valuations. And there are companies that are in that space that are playing the Amazon game that'll never make it.
Well, the interesting thing I want to say was Overstock.com, Lewis. They've been reporting negative earnings for almost 10 years now. They've been on the brink of going out of business forever now, but somehow, because of driving up stock price and everything else and whatever excuse they
now they take Bitcoin, so supposedly that's going to save them.
Right. I mean, it's comical, but and it's just like the show. If we were to, those same people that are investing in Overstock and in Amazon, if they were to go to a local business and find out that they had $4 million in revenues, but they made negative $100,000, would they invest in that company? Maybe, right? If they could figure out what was actually taking place, but not unless they were probably going to get 50 to 75% of that company.
Well, here's how I look at it, Ryan. Yeah, this is a good rule for investing. Let's look at a company, let's say Zillow. It has a market cap of $4.2 billion. And you ask yourself the question, if somehow I was fortunate enough to have $10 billion or even $5 billion, would I buy Zillow? Would there not be a better place to put my money? So let's say if you own Zillow at $4.2 billion and you take it out of the stock market, now you own it, and you're going to live off of the cash flow and the profits that they produce. Would you take that bet with your $4.2 billion and
Absolutely
say,
not.
well, for the next 3 years I'm going to lose $20, $30 million. That's all right. I have a $4.2 billion asset and I can write it off. So seriously, I mean, that's how you have to look at it. When a company has that market cap and no PE, what would you get out of it if it wasn't in the stock market over 20 years? What would you be able to, how much of your investment would you be able to get back? And then could you sell it to somebody else for $6 billion?
Yeah.
The answer is no way. It's only in the stock market that these market caps are achievable.
Yeah, I mean, and it's not like we're going around saying that, oh, look at this, a cleaning company on the corner over here. Look how they're thriving right now, right? We're not.
Well, a cleaning company, if somebody wants to sell it to you for $3 million, and let's say they make $200,000 net profit a year, you could say, okay, I'll take that because in 20 years I'll make my money back and I'll have a business.
Correct.
That kind of makes sense, assuming you can make that kind of money.
Right. Well, and, that goes back to, when you pay attention to basically how Warren Buffett has always approached his investments. There's always long-term investments in buying companies like, painting companies and carpet companies. And
real estate. He has Berkshire Hathaway real estate.
Exactly, yeah.
He can model out how much money he can make at a net profit from owning those assets, which you cannot do with Zillow and LinkedIn and Twitter and those types of companies, Facebook. You can't even make up a model, so they make up fake models.
Correct.
To justify the thin air valuation.
And what does he do when he's ever asked a question, Warren Buffett, on a technology stock? He laughs, right? He says, I don't
understand it. Even if I did, what I see, I don't like.
It pretty much tells you everything that we just talked about right there. It basically, he feels that there is no value in those, and it's all just artificially created value, right? Like the rest of our economy.
Unbelievable. That is what our economy is based on, the rising stock market, and a lot of it is on these gains for the last 3 years. If you invested money in the companies I just mentioned, you'd have made a fortune. Even though the company itself doesn't make a fortune, doesn't make anywhere near, doesn't make anything. Put the three of them together, they lose even more money.
Right. But you'd have had to been lucky enough, to have money to invest in these companies, right?
Yeah, but it goes against common sense. Even if you only had a small amount of money, you'd say to yourself, I'm taking a big risk here. I'm investing in a company that's been public for a few years, doesn't make any money, and then you hold on to it 3 years, it still doesn't make any money, but your stock price goes up. Now you learn a very perverse investment mentality is metrics don't matter, economics don't matter, profit doesn't matter, momentum matters, and what the Fed does, and they encourage me to speculate, and I got my money out. You would have thought that after the financial crisis, people would, and this is what the Fed didn't want, people would have hoarded their money because they wouldn't trust the stock market. They can't have that. They would have purchased physical assets like gold, silver, real estate. They didn't do that. Well, they kind of did it, but they've scared them off of that in the last 2 or 3 years.
Yep.
Because they make money running the casino. And if you think the casino it doesn't give out returns, it doesn't pay out, you won't go there. But they're saying, look, you put your money in the casino, we're going to spit out a return for you.
Yep.
And they've done
it. Everybody has their rose-colored glasses back out, right? I mean, it's just how quick we forget, where we were. And it's I'm just utterly amazed, Lewis, of all the numbers that are out here and how the spin that's taking place. Not that the media spin hasn't been taking place for eons, but it's just, you and I are just talking about basic level stuff right here, right? We're not creating any complex algorithms or anything like that. We're just looking at what face value, what we have going on right here. But yet, let me talk to somebody that's on Wall Street or anybody else. They will just look at me like I'm crazy, like I'm Ron Paul or something. You know what I mean?
The point is, you if they're making money doing it, it validates what they're doing.
Correct. Yeah. But
if everybody sees the emperor has clothes on when he doesn't, and there's a value placed on seeing something that doesn't exist, you win.
Correct. And all good.
You could say it's
things.
short term, but these guys get out before it collapses. They make money pumping it up. They pull their money out, and then they go pump something else up.
Yeah, and and more or less, a lot of our listeners are just the everyday average consumer who is just trying to get more educated about the markets. And the only thing that you can do, like I said, is to try to protect yourself from what's potentially going to take place. I mean, there's plenty of people that do invest in the stock market, and that's completely fine if you understand it. But I hope you are still paying attention to the economic things that we're talking about here, which is the Federal Reserve and how they're manipulating it, and how the economic reports are going to be interpreted by the Federal Reserve. Don't worry about anything else. Because
eventually, Ryan, companies that make no money will crash. Everything eventually gets, and even if they don't go out of business because they have a lot of cash on the balance sheet because they'll still be around because they won an IPO and they made $200 or $300 million and they haven't blown through it all.
Right.
Eventually, companies on a timeline revert to what they're actually worth. It just takes a while, and you have artificial manipulation preventing. Bubbles last longer today than they did when they were just based on mania, because mania is short-lived. But if you have mania combined with Federal Reserve pumping, the mania can last a lot longer.
Yeah.
Because, when you had a tulip bubble, I don't think that tulip bubble went on for 3 or 4 years in 17th century Holland. It was a few months. We had the internet bubble from 1996 to 2000, right? It was 4 years. Who would have thought it could have gone on that long? Same with the housing bubble. Same with this current stock market run.
I can see, in 2020, where this decade would be considered basically the decade, the lost decade of artificial manipulation by the Fed, right? Because the course that we've been on for how long now, Louis? I mean, you and I we always
half its entire generation. It's 6 years.
Yeah, I mean, at some point, something's got to change. But it looks like they're going to continue to pull this off. For how long, I don't know. Like I said, I'm just going on record at least through the end of Obama. But then I'm pretty much convinced that Hillary's going to win the next election. She can continue that on for maybe another 4 years. But at some point, something's going to happen geopolitically that's going to, I think, force us into a different direction, whether that's Russia or China, devaluation of the dollar. Something's got to give. And, really, the only thing that people can do is just to stay on top of what's taking place, of the Fed's decisions, and listening to our show, listening and making your own interpretations, obviously based upon what you see going on. But for the most part, I just keep the eye test going, because you can pretty much tell what's going on by just walking out to, basically going up and down certain streets, going to the grocery store, looking at gas prices. I mean, everybody's pocketbooks are getting hit a lot harder right now than they were 3 years ago, and they're not making any more money.
Well, it's the inflation myth. You have beef at all-time highs, energy at all-time highs, home prices near all-time highs, but somehow inflation is benign and the consumer should be okay. Well, how can they be when their biggest expenses have gone up and their wages haven't gone up at the same rate? But what they'll tell you is, well, the CPI is flat. Yeah, because they manipulate that too.
Yep. Well, Louis, we're coming up on the end of the show, but I want to thank you again for coming on.
Thank you.
Wouldn't mind telling our listeners where they can go to check out your blog and any questions that they may have for you, how they can get in contact with you.
Sure. You go to smallgold.com, SMAULGLD. As we mentioned throughout the show, we have a blog post or 2 or 3 a week on the economy, real estate, gold, silver, anything that's going on that might affect the housing market or the financial markets or the gold and silver markets. So it's smallgold.com.
Perfect. Thank you, Louis.
Thank you, Ryan.
Thank you guys for tuning in. If you have any questions or concerns, give us a call. 877-245-2030, or you can go to the website at realestate360live.com. That's realestate360live.com. Don't forget to subscribe, download, leave reviews on iTunes, search Real Estate 360. Until next time, take care.